Here we are now at the first unit of Chapter 4, when we're going to now start talking about monetary and fiscal policy. Monetary policy is controlled by the Federal Reserve Board. The Federal Open Market Committee is part of how the Federal Reserve Board helps do its power of controlling monetary policy by buying and selling treasuries. The Federal Reserve Board also sets the discount rate. All other interest rates are based on the discount rate. Only the discount rate is actually directly set by the Federal Reserve Board. The reserve requirements are also set by the Federal Reserve Board. These three things help the Federal Reserve Board control inflation. We're going to be talking about that in the next slide. Regulation T also falls under the Federal Reserve Board purview. Regulation T is the margin requirements. Currently, it requires a 50% down payment. If you want to buy $100,000 in securities in a margin account, you need to put down at least $50,000. You must also pay the broker-dealer within 2 business days of the trade date, or your account will be frozen for 90 days. Should your account be frozen, that simply means you can only do cash trades. As in, if you want to buy an additional $50,000 in securities, you need $50,000 in cash because they are not going to be extending you any credit. Now, theoretically, you can purchase mutual funds on margin. There are certain rules, so this no mutual funds on margin is a little bit more complicated, but no one ever does, and the rules are a bit stringent. It's very difficult. So effectively, you want to think of that you really can't do mutual funds on margin. Now, this T+4, this 4 business days after the trade date, is actually broken down into 2 parts. Regular way settlement follows T+2. You have 2 days after trade for it to settle. With Reg T, you have an additional 2 days after that, settlement +2. So you've T plus 2 days plus an additional 2 days, hence we get to the T+4. The prime focus of monetary policy is to control inflation. They supervise and regulate the banks along with the IRS and the Treasury. They maintain stable financial system, and they tighten and loosen the money policy, the money supply, in order to help control inflation. Inflation cannot be directly controlled, merely influenced. This is a chart of how the Federal Reserve Board uses their powers to increase or decrease money in the economy. Because increasing money in the economy is likely to cause increased inflation. Decreasing the money in the economy is likely to cause decreased inflation, potentially to deflation. What we need to understand as well is, like many things in this world, just because it exists doesn't necessarily mean it's good or bad. Inflation is not necessarily bad. It can be good. We need some inflation, or the money doesn't grow, we don't have enough money, and the economy stalls because there's not enough money to do anything with. So you want some inflation, just not too much inflation. Now, if they're going and buying treasuries, well, what does that mean? If I, as the Federal Reserve Board, am buying a treasury from you, the general public, that means I'm giving you cash, right? I'm then taking your security. When I take a security, or when we see shortly when I take cash, I put it in my vault. Understand the Federal Reserve Board vault. There is nothing on earth that does less with money than the Federal Reserve Board vault. It's not earning interest. It's not being invested. It is just locked away. So if I'm taking securities and putting them in my vault and taking money out to buy them, I'm increasing money in the economy. If I instead sell treasuries, that means I'm taking treasuries from my vault, I'm selling them to you, the general public, which means you're giving me money. I take that money and I lock it in my vault. That's decreasing the money in the economy. I could lower the discount rate. The Federal Reserve Board consists of 12 member banks. Spread out around the country, you can go and look at the map. It doesn't really matter. Some of them cover more states, some of them cover very few. There's the big main one in New York. Okay. Those 12 member banks borrow from the Federal Reserve at the discount rate. If I lower the discount rate, that means those member banks can borrow from me for less money, which means you can borrow, the member banks have commercial banks that report to them. The commercial banks borrow from the member banks at what's called the federal funds rate. whatever the discount rate is, the federal funds is a little bit more, and the rate that they charge us, the regular retail person, is going to be a little more than that. But if I lower the discount rate for the member banks, then they're going to be lowering the rate for the commercial banks, and they're going to be lowering the rate for retail investors. And if there's a lower rate, it's easier to get a loan. There's going to be more people taking more loans, thus more money in the economy. If, however, I raise the discount rate, that makes it more expensive for member banks to borrow money from me. They're going to raise their rates on their commercial banks, and the commercial banks are then going to raise their rates on retail people. So if it's harder to get money, if it's more expensive to get money, people are going to get less. Thus, there's less money in the economy. I could also change the reserve requirement. The reserve requirement is how much money of each member bank must be in my vault. If I decrease the reserve requirement, that means the member banks have to keep less money in my vault, more money in their vault. More money in their vault means more money they can lend out, more money in the economy. If, on the other hand, I increase the reserve requirement, that means the member banks have to keep more money in my vault. More money in my vault means less money in their vault. Less money in their vault means less money they can lend out. Less money they can lend out is less money in the economy. This is how the Federal Reserve Board helps deal with inflation. And inflation is generally a sign of there being too much money. As a simple example, this can never really happen, but as a simple example, if we think about tomorrow, everybody in the country, every single person in the country wakes up and has $1 million in their bank account. How many people do you think are now going to get out of bed to go and sell a $5 gallon of milk and make $2 doing it? Not a lot of people. Now, are they going to be willing to go and sell a $50 gallon of milk? $100 gallon of milk? It needs to be enough of a profit where it's worth doing anything if they've got $1 million in the bank. That's never going to happen. You're never going to have suddenly that kind of inflow of cash. But that should, as sort of at least a simple idea, explain why price increases are caused by too much money. Fiscal policy. We just talked monetary. This is fiscal. This is controlled by the President and Congress. The primary focus is to stabilize economic growth, to have high levels of employment. The President and Congress are concerned about economic growth and employment. That's not what the Federal Reserve Board cares about. They just care about inflation and money supply, money policy. Interest rates. I mentioned some of these when we were talking before, but the discount rate, this is the rate member banks borrow from the Fed at. The only rate that is directly set by the Federal Reserve Board. The federal funds rate is the rate that commercial banks borrow from the member banks at. The target is set by the Fed. The Fed goes out, we think it should be around this. But the actual rate itself is set by the individual member banks. The 12 member banks may have 12 different rates they're lending out to their commercial banks. The broker call loan rate, this is a rate for margin accounts. Just like the federal funds rate, all of these, other than the discount, is based on the discount rate. When the discount rate goes up, all of the other interest rates are going to go up too. If the discount rate goes down, all of the other interest rates are going to go down. And if you hear about the Federal Reserve raising or now lowering interest rates, they're now raising them. They had been lowering them. They're talking about the discount rate. The prime rate is the rate that lenders charge to their best and highest credit borrowers. Generally, these are going to be high credit corporations, but certainly normal, incredibly wealthy, incredibly high quality credit score people may be able to get pretty close to prime. But normal people are going to be paying points or fractions of a point above prime. 1, 2, 3, 4, 5 points above prime, depending on what their credit scores are. So there's another one of Randy's cartoons here. Look at the bright side. Bad credit is your best protection against identity theft, which is actually sort of true. That brings us to the end of this unit. I hope you enjoyed it and found it useful. Definitely want to look through this. Fiscal and monetary policy are definitely things that they may try and mess you up with. Make sure that you understand that monetary policy is controlled by the Fed, whereas fiscal policy is controlled by the President and Congress through taxes and how they spend their money. See you again shortly.